This is Bobby Axelrod from Billions. Smart, ruthless, and untouchable. He's the ultimate Wall Street titan. But what if I told you his character was inspired by a real-life billionaire? Meet Steven Cohen, owner of the New York Mets and one of the most successful hedge fund managers in history. Steven Cohen is worth $21.3 billion today.
But also, Steve Cohen was a legendary figure on Wall Street. He was one of the most successful hedge fund managers of all time.
At one point, his hedge fund, SAC Capital Advisors, was making an average of 30% returns per year.
There were people who wondered, what he was doing to generate these incredible returns, but he was an icon of the industry.
But by 2013, SAC Capital was charged with insider trading, forced to pay a $1.8 billion fine, and banned from managing outside money. Yet Cohen never set foot in jail. How did Cohen rise from a modest middle-class family to become a Wall Street powerhouse? How did SAC Capital fall from grace without taking him down? And what lessons can you learn from his incredible story? Stick around to find out how Cohen's unconventional choices, both in the boardroom and beyond, helped him redefine success. Chapter 1. The Rise of Steven Cohen. Steven Cohen wasn't born into wealth. His father owned a small, struggling garment business, and his mother worked as a piano teacher to make ends meet. The family was firmly on the lower end of the middle class, and money was always tight. But Steven's maternal grandparents, Walter and Madeline Mayer, offered a glimpse of a different life, one filled with Broadway shows, fine dining, and financial freedom. Their stories about investing and earning interest fascinated young Steven, planting the seeds of his future obsession with the stock market. Cohen's early curiosity turned into action when he began studying stock tables from his father's New York Post. By high school, his passion for financial markets was undeniable. But it wasn't just stocks that captivated him. Steven discovered poker. He and his friends would play all night, and Steven quickly learned that success at the poker table required strategy, risk management, and an uncanny ability to read people. These lessons became the foundation of his approach to trading. At Wharton, Cohen's focus on poker only intensified. His fraternity, Zeta Beta Tau, was nicknamed Zillions, Billions, Trillions because of its wealthy members. But while most of his fraternity brothers flaunted their family money, Steven saw poker as a way to build his own fortune. By the time he graduated, he wasn't just a skilled player. He was a master at reading the room, a skill that would serve him well on Wall Street.
I didn't go to class a lot at Penn. What I used to do is go down to the local brokerage firm, and I would stand outside, no matter what the weather was, in big glass, and watch the ticker tape go across. And so I'd be out there every day, and eventually they invited me in to sit with the brokers.
After college, Cohen landed his first job at Grundle & Company, a small brokerage firm near the New York Stock Exchange. It wasn't prestigious, but Steven didn't care. On his very first day, he made $8,000 profit from a trade, a staggering amount in 1978, equivalent to nearly $40,000 today. His boss, Ronald Azer, was stunned. How could a rookie be this good? Steven's talent for predicting market movements quickly earned him a reputation as a rising star. But Cohen wasn't just about big wins. He was about resilience. He had an uncanny ability to hold his positions, even when market conditions turned chaotic. While others panicked and sold, Cohen stayed calm, trusting his analysis. By the mid-1980s, he was making $5 to $10 million a year at Grundle. But Steven wanted more than a paycheck. He wanted control. In 1985, he struck a deal with Grundle to manage his own trading group, complete with a team of traders and a hefty pool of capital. His instincts proved right when a trade on RCA shares, based on market chatter, netted him $20 million. But success came with scrutiny. The SEC launched an insider trading investigation into the RCA trade, and Cohen had his first run-in with regulators. While his lawyer expertly navigated the case, Steven learned a valuable lesson. The line between legal and illegal trading was razor thin. By 1992, Cohen was ready to strike out on his own. With $10 million of his own money and $13 million from outside investors, he founded SAC Capital Advisors. At just 36 years old, Steven Cohen was on his way to becoming one of the most powerful figures in finance. Chapter 2. SAC Capital Scandal. SAC Capital didn't just succeed, it dominated. Starting with a small team of 9 employees, Steven Cohen built SAC into a financial juggernaut, managing $17 billion in assets at his peak. His strategy was simple: foster fierce competition among his portfolio managers. Each week, they pitched their best trade ideas to Cohen, complete with a confidence score. If you delivered, you were paid like a star athlete. If you failed, you were out. The stakes were high, but so were the rewards. Traders at SAC started with a base salary of $200,000. However, their sign-up bonuses could reach an eye-popping $2 million, and bonuses based on portfolio performance made their total annual earnings skyrocket. For instance, a trader managing a $400 million portfolio could easily take home over $10 million in a good year, thanks to SAC's profit-sharing structure. Steven himself was in a league of his own. In 2006, Steven Cohen took home $900 million, a figure that dwarfed the earnings of Wall Street's top CEOs. For contrast, Lloyd Blankfein, CEO of Goldman Sachs, earned only $54.4 million that year. Steven Cohen didn't just splurge on the markets, he had a taste for the outrageous in art. One piece he famously added to his office was Self by conceptual artist Mark Quinn. It's a sculpture of the artist's head, crafted from 8 pints of his own blood and preserved in a custom-built refrigeration unit. The sculpture prompted murmurs of unease among his employees, yet it perfectly reflected Cohen's appetite for risk and bold choices. Another centerpiece of his collection was Damien Hirst's The Physical Impossibility of Death in the Mind of Someone Living, a tiger shark suspended in formaldehyde. This audacious piece mirrored Cohen's fearless approach to both art and finance. But SAC's success wasn't built solely on legal trades. The firm became infamous for its use of Black Edge, illegally obtained non-public information that gave traders an edge.
So it's important to understand that hedge funds are driven by information. And if you're trading in the stock market each day on a kind of a short-term speculative basis, the better the information is that you have, the more money you're going to make. That's the general philosophy. So everyone is out there trying to get good, usable information. Inside SAC Capital, they had different categories of information. There was White Edge, which is publicly available information that anyone can get, like information that is in an SEC filing that a company makes. Not very useful to a trader because everyone already has that. There's Gray Edge, which is in the gray zone. It might be something that an executive at the company told you, but it wasn't entirely clear what they meant. You're not quite sure. You might have to talk to your legal counsel before you can trade on that information. And then there's Black Edge, which is clearly material, non-public information, inside information. For example, access to confidential drug trial results before they are released. And a person could make a lot of money trading on that kind of information.
In finance, the stock markets are said to be efficient, meaning that all publicly available information is already reflected in stock prices. To outperform the market, you need something others don't have. For SAC's traders, that something was insider information. Here's how it worked. Traders at SAC cultivated networks of analysts, consultants, and even corporate insiders to gain access to privileged information. This intelligence was funneled into their confidence scores, which Cohen relied on without asking too many questions. Over 18 years, SAC's average return was an astonishing 30% per year, triple the industry average. But by 2013, the walls were closing in. 8 SAC employees were charged with insider trading, and the SEC turned its sights on Steven Cohen. Yet despite years of investigation, prosecutors couldn't find concrete evidence linking Cohen directly to illegal trades. Without wiretaps, emails, or testimony, they couldn't make a case against him. Instead, SAC Capital itself was charged with conspiracy and securities fraud. The firm pleaded guilty, paid a record $1.8 billion fine, and agreed to stop managing outside money. For most hedge funds, this would have been the end. But Cohen wasn't like most hedge fund managers. In the wake of the scandal, Cohen rebranded SAC as Point72 Asset Management. The firm focused solely on managing his personal fortune, which still amounted to billions. By 2018, the ban on outside investments was lifted, and Point72 reopened its doors to external clients. Today, it manages over $26 billion, a testament to Cohen's resilience and market prowess. Chapter 3. 7 Lessons for Success from Steven Cohen. Steven Cohen's story is one of ambition, controversy, and reinvention. Here are 7 key lessons from his journey. 1. Work ethic that never sleeps. Steven Cohen didn't just work hard, he maximized every second of his day. His mornings began with intense market analysis at home before being whisked to the office by 8 a.m. in a gray Maybach driven by his bodyguard. To Steven, every hour of every day was a chance to make money, and he made sure not to waste a single moment. SAC's incredible success was built on this relentless drive. 2. Always be learning. For Cohen, knowledge is power. He made it his mission to know more than anyone else in the room. That's how his lawyer managed to outsmart the SEC during his first investigation. His team knew the law so well that they maneuvered Cohen out of a tight spot, making him plead the fifth without ever explicitly stating it. Cohen's approach? Learn everything you can and be ready to apply it when it matters most. 3. Maximize productivity. Like it's an art form, Cohen treated every minute of the trading day as sacred. His desk, the nerve center of SAC, was surrounded by 12 monitors, each streaming crucial market data, haircuts, meetings, meals. Everything happened right there to ensure he never lost focus between 9:30 a.m. and 4 p.m. Cohen's time was so meticulously planned that even the smallest distractions were eliminated. Productivity wasn't just a priority, it was a lifestyle. 4. Reflect and strategize. Cohen's Sundays were dedicated to one thing: planning the week ahead. With a yellow notepad in hand, he listened to his portfolio managers pitch their best trade ideas during the infamous Sunday Ideas meeting, a weekly ritual that struck both fear and admiration into his team. For Cohen, reflection wasn't a luxury, it was the secret weapon behind his razor-sharp strategies. 5. Stick to a routine that shields you from chaos. Routine wasn't just a comfort, it was a tool for success. Every morning, Cohen's day started with a warm bowl of oatmeal at his desk. When traveling, he sent a prep team ahead to set up a duplicate of his trading desk, complete with 12 monitors, ensuring he could hit the ground running no matter where he was. Familiarity and routine allowed him to maintain peak performance under any circumstance. 6. Take risks, but always cap the downside. Trading is all about taking calculated risks, and Cohen was a master of the game. Every trade was backed by logic and research, and he never let emotions cloud his judgment. But here's the kicker. Cohen knew when to stop. Like the saying goes, don't risk what you have and need for what you don't have and don't need. He capped his downside while leaving room for massive rewards, a hallmark of a true financial strategist. 7. Keep your goals private. Cohen understood the power of silence. He controlled who had access to him and his plans, ensuring that only trusted individuals knew his moves. This secretive approach wasn't just about avoiding unnecessary scrutiny, it was a calculated strategy. Compare this to Rajaratnam, founder of the Galleon Group, who bragged about his trades over the phone, only to have those calls used as evidence against him. Rajaratnam went to prison for 11 years. Research backs Cohen's approach. Sharing your goals prematurely can trick your brain into thinking you've already accomplished them, giving you a false sense of satisfaction and making you less likely to achieve them. Keep your goals to yourself, work quietly, and let the results speak for themselves. This video was inspired by Black Edge, Inside Information, Dirty Money, in the Quest to Bring Down the Most Wanted Man on Wall Street by Sheila Kolhatkar. It's a thrilling deep dive into the world of hedge funds and insider trading, and we highly recommend it. If you decide to pick up a copy of the book, please use the Amazon link in this video's description to support the channel. Your help is greatly appreciated and enable us to keep producing videos like this one. Your support means a lot to us, so if you liked it, don't forget to give this video a thumbs up and subscribe for more. If you enjoyed this one, you'll love the next video we've picked just for you, right here on the screen. Thanks for watching, and I'll see you in the next video.